Hello and welcome to another episode of the Real Estate Investing Club, the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items to cover. First, if you like the episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running. Second, if you are a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, we created an ebook for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All we charge is our admin cost to keep the show running. So, if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says Get the ebook to grab yourself a copy today. So with that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride. All right, we are back with another episode of the Real Estate Investing Club. Today we have Agostino Pintus from Bulletproof Cashflow, not to be confused with Bulletproof Coffee. Definitely, we just had this conversation. So Agostino, thank you very much for hopping on the show.
Hey man, thanks for the invite. I appreciate it.
There you go. I told you before we got on the show, we like to start with stories. We like to hear how people kind of got to where they are today. And I'm sure you got a good one because you're in so many different areas. So why don't you take us back to the beginning? How'd you get started in real estate?
The very, very, very beginning. The very, very, very beginning is in single family, really. When I used to work in corporate America a long time ago, I worked with a company. We just went public. I was flush with cash. Many of us executives were. And my buddy says, you gotta start buying single family homes. So I'm like, okay. I mean, it's like there's no strategy at all. I'm just going to go ahead and start buying this stuff. Just buy them, right? No idea what I was doing. And I'm buying them at retail.
Oh, man.
He gives me his real estate agent's, her name and start buying stuff at retail. But many of the fundamental things that I learned from even 17 years ago, I still do to this very day. There's a thing about when you first step foot on a property, I don't put myself in the mindset of a buyer. I put my mind, or rather of a buyer. I put myself as a mindset of an actual tenant or someone living there as a resident. How do I feel about this place? If I don't feel good about it, I won't do the deal. I just won't do the deal. Yep. So I know that largely there is a financial aspect to this business, right? Of course there is. It's what it is, right? But at the end of the day, it's all those financial aspects are made of people, and individuals need to want to live there. And if nobody wants to live there, you can have the best asset in the world. It
could be, live there, rent storage there, operate their businesses out of there. That is, it doesn't really matter if it's multifamily or any other type of commercial asset. It has to be, it has to be somewhere you want to be.
Yeah. But that was my first foray was in single family, and went through a whole lot of stuff. Went through the 10 dark years, which that itself is like an hour length show. But so I won't get into any of that. But at the end of all that escape from corporate America, I realized that commercial real estate was where I needed to be. I've realized that, and the bigger the deal, the better the deal. So today we shifted now to doing three primary lines of business. The first is the stabilized B and C type of assets. The second is development and redevelopment type of deals. And the third is single tenant net lease, or a fund that goes and buys all these types of deals, right? So, it's very, very exciting to do that. So, yeah.
Nice. I love it. So how many, you said 19 years ago is when you first got started and, you got out of corporate and that's when you bought your first house?
Yeah. So more like, God, what? It seems like 17 years, maybe a long while ago, but I didn't get out back then. I mean, I've been in corporate. I escaped corporate probably closer to about 4.5, 5 years ago now, where I just, I bet it all on a sure thing.
Yeah.
Me, because and it's always a little risky. It's not risky. It's not risky. It's actually less risky to take it on yourself, believe it or not, in my opinion. It's more certain when you do things on your own, right? But I think at the same time too, you have to be an extremely motivated person inherently. You have to be. And entrepreneurship is just not for everybody. It just isn't.
Yeah.
Unlike what some of these other guys would say, there's a lot of gurus out there. I don't want to throw stones or whatever, but anybody can do this. No, not anybody can do this. It
You
takes
got to be able to take the hits. That's for
you got to
sure.
be able to take the hits, and you have to be able to not get. It's a very, very tough business. Real estate is certainly not for the faint of heart. Certainly
Yep.
not for the faint of heart. Absolutely. Yeah.
Yep. And it sounds like, you learned that firsthand. You said 17 years ago, that would be 2005, which is right
Uh-huh.
before 2008, 2009.
That's
So
right.
you went through the worst that we've seen, at least I've seen in my lifetime. And you came out the other side. During that period, were you in single family, or had you already gone over to the commercial side?
So no, it was already in commercial, but
Okay.
we did have some single family, right? No, I'm sorry. Back in 2008, no, that was all single family back then.
Oof.
But here's what I did. All right, the way that I did it was smart in the sense that uh, back then I would not say that I was any type of single family genius. I was not taking any courses. I was not doing any mentorships. I was not doing any of that stuff. I just applied basic business logic, right? And at the time, I was a C-level executive. They were doing loans. I remember they're doing interest-only loans on a freaking single-family house, man.
Oh,
And I'm
wow.
like, yeah, that's right. And the bank was doing this. Not a hard money guy. The bank was doing these
Right,
loans.
right.
And I'm like, and I didn't fully understand. Like, I knew it was messed up. I knew it was messed up. I didn't know why. Right? It's kind of like because I didn't have the understanding back then. But the way I did all my loans were 30-year fixed,
There you go.
super low interest rate. I did it all the same way. And the logic behind it was if the economy went to hell in a handbasket, I know that my mortgage is this much, and I know I can rent it for this much. So if my mortgage is $600, I can rent it for 900 or $1,000. Great. I have a little bit of room in there. And if I did have to kick up any extra money, the spread isn't that much. Whereas people were trying to shoehorn themselves into these deals back then. And
You got
doing
these variable rates.
doing variable rates. I didn't do any of that stuff. I have personal friends that did all that. They got killed. They got slaughtered. And that's the thing though too. The fundamentals from even back then, not just on how to find assets, but even how we finance stuff. I still apply that stuff. Those simple rules are still applied to this very day to build out this portfolio of stuff we have now. Like right now, I have about $350 million worth of stuff. So in a variety of different asset classes. So, yeah, man. I mean, it's the same logic. It's the same logic that we apply. We're always very, very careful about what we're getting into. That's the underlying scenario. That no matter what we do, we're very careful about what it is that we do and how we do it.
Yeah, absolutely. Being careful when you first buy. I can't remember who first said the quote, but you make your money when you buy it. I'm sure is like, I don't know, Rockefeller or something like that. But if you buy correctly, I'm 100% certain that you're not going, well, not 100%, but there's a high likelihood that you're not going to lose money if you buy correctly, fixed rate loans, things like that. I've heard so many doomsday people saying that you got to get out of real estate right now because the market's going to crash. And I'm just like, no, that's not necessarily true. You just make sure the deal works out.
Those people don't understand how real estate works, right? Now, there's certain aspects. I mean, again, it's all personal beliefs, right? There is some data behind crashes and things like that. People are anticipating a crash going down in like places like Florida and Texas, a repeat of similar to 2008. Now with the same issues that plagued the 2008 crisis in terms of illegal activity and things like that, but more along the lines of it's a supply and demand issue. Yeah, it's a supply and demand issue, and now there's a rational exuberance. There's that terminology from Greenspan that you probably never heard that term before, but there was a real big term back in the crash, rational exuberance, that really it's driving the prices of these single family homes up to a level that doesn't make any sense. So let's say back a few years ago, 3 or 4 years ago, if you made $60,000 a year, generally speaking, the price of the house was, 4 or 5 times whatever you're earning in a year, and that was considered affordable. You can swing something like that. Now it's more like 7 to 8 times.
Yeah.
The same $60,000 salary. It's just not sustainable. It just isn't. So people are just saying, people in general. I think it's just people in general. It's just saying that given where interest rates have gone, people have already seen a slowdown in the market. I know I have, in the single family space anyway. But at the same time, too, they're predicting that there will be some sort of huge slowdown, maybe even a crash. You're going to see a 20 or 30% decrease in pricing when it comes to some of these assets, right? So, but you know what? Hey, listen, if you're in the rental market and you're locked in for a lease and you didn't overpay for the asset and you're still making money on a monthly basis, then you're fine. I mean, that's a long-term play, right? But if you're like having to kick up cash every month, yeah, you got to get out of the deal like right now while you can. So there's an if-then type scenario cooking here. It isn't like it's not like it's a blanket statement like a lot of people like to make. So.
Yeah.
But I only stick to multifamily and development stuff. Obviously, net lease is a big part of it too. But net lease is its own animal. But we're only sticking to one market, and that's Cleveland, right? I know this market very well. I know what the housing market here is. Even though we're building a single or multifamily, so all we do is multifamily. There's the city has never really recovered from the last crash. Right?
Oh, really?
So there's always a housing shortage here to begin with. Even now, I mean, we're getting ready. We're shutting down. We're getting one deal built out now. It's only 42 units. It's going to be pre-leased here soon. Before we actually before the contractor turns the keys over, we'll have the whole place leased out.
Yeah. So why? I mean, you focus on multifamily development and then single tenant net lease only in Cleveland. Why did you choose first those three? I guess development, you're developing multifamily, so I'm just going to bucket it into multifamily and single tenant net lease. So why did you choose those two strategies, those two asset classes in Cleveland? Why not expand? Why not look into things like multi-tenant industrial or anything like that?
Sure. So single tenant net lease that's actually national, right? So we're looking mainly in red states, mainly suburban areas. We avoid the blue areas. No, I'm not going to turn political or anything else like that. But no surprise, blue states have higher tax rates. If you guys don't know that, surprise, surprise. There you go. There's your tip for the day. So we stay away from those areas. Higher propensity for those tenants to bounce to, depending on, of course, the area, right? So we're very opportunistic when it comes to the net lease portfolio that we're building. But when it comes to the multifamily, it's there's development and stabilized assets, though. They have to be in two separate buckets. So each one of these three buckets have three different return profiles, right? And that return profile is based on a risk-adjusted return, right? Yeah. So where development, there's a perception of a high level of risk, right? The deals that we do are very low risk, in my opinion. Like this deal I'm in right now, this is John D. Rockefeller's old office building in Cleveland, Ohio. Before he was run out of town, this was his building. Right?
I didn't know he was from Cleveland. That's pretty interesting.
People don't know that, right? He ended up going to Rockefeller Center in New York.
Yeah, New York.
He built it out there instead, right? Where he was welcomed out in New York. But the thing is about this deal, we're going to build 430 some units. Right, literally right next door. Sherwin-Williams is moving in right next door.
Nice.
Yeah. So world headquarters moving in right next door. It's going to bring at least 6,000 jobs. That's
some good paint right there for sure. I'll support that.
But the types of deals that we're doing, we're also building four ground-up developments near Cleveland Clinic, like all walking distance to the main campus of Cleveland Clinic. They're going to bring on 20,000 new jobs over the next 10 years, right? And those people need housing. Those doctors need housing. The people, the support staff need housing. All those folks need a place to live. We're doing stuff. We're actually doing another redevelopment similar to this, an office conversion over in Rocky River. Rocky River is a very nice high-end area, right? in a high-end area like that, they're not typically concerned with they're concerned with economic situations, but they're not as concerned as other folks might be, if you know what I mean, right?
Right.
Those are typical, that type of demographic. They make very high income. They're not worried about what's going on in the economy. So those are the types of deals that we do. They have a very different return profile than, say, single tenant net lease. Even though we're buying it as a fund, okay, it's a monthly return, and there's a corporate or franchise guarantee behind it. So we know that every month that check's coming in, and then you can count on it. Yeah, it's extremely predictable. I can tell you the third every month, an ACH is hitting your account, right? You can't really say that with multifamily. You can't say that with self-storage either. If you're syndicating it, you can't. You just can't do it, because things break. People are late with payments, whatever the case may be. Well, at least
you never know. Things come out of the woodwork, and it just happens. And
it just happens, right? Yep. So we have these three different buckets for our investors. In the case that any one of these investors want to build out their portfolio, well, we have three different options. So the reason why we actually did multifamily development and redevelopment is because on the multifamily side these days, as I'm sure you know, the cost per door, even here in Cleveland, is extremely ridiculous, extremely high. It's nuts, right? Yep. And there's an asset that was marketed over to me the other day. They're asking like $75 a door, which seems cheap. I bought the same product earlier this year for $35 a door, and now they're trying to ask for $75 for the same product. Yeah. It's the same product, 60s build, nothing crazy, brick exterior. It's the same stuff, same square footage. Doesn't make any sense. I'm not doing that deal. I just won't do it. It doesn't make it doesn't make any sense. Whereas if I develop stuff, at least here in Cleveland anyway, I get two things: opportunity zone, which is huge, and I get a 15-year tax abatement. Right? Okay. So those two things, the OZ is great for the investors. So they put in $100,000, for instance, and they when at the end of this 10-year period, and we go to cash this thing out, all the capital gains comes back to them at 0% rate. It's beautiful.
Oh, interesting. Okay.
Yeah. And the second thing is that with a 15-year tax abatement, there's no taxes. You're not paying any taxes, no city taxes on that asset, right? So NOI goes through the roof. So it's a great, great, great deal. Not all opportunity zones are created equal. A lot of them are real bad areas, like really terrible, terrible areas. So
I actually, I looked at a multifamily in Cleveland at one point that was in an opportunity zone, and it was dirt cheap. And I was thinking about going on it, but I started calling property managers in the area, and they were like, "You will get shot in that neighborhood. Yeah, it's not a place to buy."
I know where you're talking about. Yeah, I said I know the market, right? Yeah. So, but that's the thing though too. It's like all of Cleveland, like this building that I'm in right now is technically in an opportunity zone. Okay. There's a Starbucks right outside my window here.
Okay.
Yeah. There's a Ruth Chris Steakhouse right over there.
Oh. That's not an opportunity zone. That's a nice zone.
Exactly. The Key Tower is right over here. It's my neighbor over here, basically. So it tells you a little bit about picking the right type of deal. It's extremely important when you're doing development. So that's one of them. Like just to your point, not all OZ areas are created equal. Some of them are absolutely terrible that you need to stay away from.
Yeah. And so going back to the original question, it sounds like the reason that you are in Cleveland is really just, you haven't expanded into outside of, net lease. You haven't expanded outside of Cleveland just because you know the area so well. And it sounds like that is, it's giving you a competitive advantage over other people that are looking to invest in Cleveland. Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com. So if you are interested, head on over there. With that said, let's get back to the podcast.
I'm a real big believer, and we talked about this in the green room too. I'm a real big believer in hunkering down in one market and becoming very, very good at it. So I know this market very, very well. It's like building a moat around your business, right?
Yeah.
But those two aspects, I mean, I listen, I got to really believe in those two aspects of the OZ and the tax abatement. I've really got to believe in that to stick around, right? And it really is a huge motivating factor, huge. There's a reason why developers from everywhere from Cincinnati to Chicago to New York are coming here to build stuff. There's a reason why it's happening. And that's two of the big reasons right there. The cost to develop here is still very, very good. There's still a need for housing, even now, because of all the growth that's taking place. So it makes total sense, right?
Yep.
But at the same time, too, not anybody can just go ahead and do it either, right? You really have to know what the hell you're talking about. You have to have a good team developing the stuff. You have to know who's going to build it. So there's a lot that goes into development that many people underestimate. But we do it. And we have 4 deals cooking right now, 5 deals cooking right now. So
nice, man. That's good.
We're staying busy, man. We're staying busy. Yeah.
So I want to take that opportunity. You mentioned your team, building a real estate, a well-oiled machine in real estate is very difficult. I've struggled with it myself. I've known a lot of partners that do the same. So what's your kind of strategy, your tips, I guess, that you can give people on building a successful team in real estate?
I guess it really there's a couple dependencies here, man. That's the thing, if you're starting small and you have a limited budget, then maybe you can get by with assistants and BAs and things like that, and then graduate to actual American people that are in your office working with you. And I don't mean American in the sense that I'm not racist.
Local people,
like local people, right? American workforce, meaning someone local.
Right.
It's because right now a lot of our staff is based overseas. They're based in the Philippines, India, and they're handling some of the social media stuff, some of the website development, some of the podcast stuff that we do as well. But we do have some local guys that helps with photo, video, commercials, things like that. They're also helping us here in the States. When I say American, there's an American group in Cleveland, Kentucky, that helps us with also additional podcast marketing as well, right? So I guess the biggest takeaway, though, that I would offer your audience is that they need to create a video library of what they want to see and how they want to see it. Because unfortunately, more so than not, especially when it comes to the overseas folks, you go through those folks fairly quickly, right? It's just I've been doing this long enough where it's like you'll be working with somebody for a year and then you just disappear. Happens.
Yeah. Had that happen to myself too.
Yeah, it happens. I mean, nobody wants to admit it, but it's true. It does, and it's because many of these folks, if someone offers them $1 more an hour, they're bouncing, they're leaving. They won't even give you a chance to they won't even talk to you about it. Because part of it's cultural. They don't want to disappoint you, so they'd rather just take the money and run as opposed to talk to you about it. But anyway, having documented methodologies to perform certain tasks is very, very important. Yep. And what's cool about it, though, is that you can even pay them to do it. Say, okay, Amy, can you go ahead and document what you do in a single day? Can you do some recordings on Loom to show me what you do here, and here? And then what you do is you can take that, put it up on a private YouTube channel, and then you can just share it out with whatever other people you need to have, right, on your team. That's a great way to really help least when you're smaller anyway, expand out the team fairly quickly if you're going to rely on some of those outsourced folks, right?
Yep.
I find there's a lot of folks in that position, and the same thing goes with if you're going to build in your own property management as well. Same sort of documentation, video documentation of doing it just that way.
Yep. And I like that you mentioned Loom. I've used Zoom even to do this, but I just recently started doing that exact same process that you talked about because I had gone through so many different VAs and I have to explain the same thing to them. And eventually I was just like, screw it. I'm going to record every single thing I do. And then if somebody decides they leave for whatever reason and, it happens, you can just show them the video and say, hey, here's the process I established. If there's improvements you'd like to make, you can go ahead and make those. But this is what we got going so far. And then it's a lot easier transition. So I like that you said that makes, struck a chord with me as well.
Yeah, you have to count on that, unfortunately, and, there's many successful companies that do this. Even like companies like Bridgewater based in Connecticut, Ray Dalio's company, he does this. So it's like, hey, listen, if it's good enough for a billionaire, it's good enough for you. Spend the time and do the same thing that he does. You won't be sorry if you do.
Yeah, it's been proven.
Yeah.
All right, I just took a peek at the clock. We have gone through our 15-minute portion, so it is time to jump into the quick question round. Are you ready?
Yeah, let's roll.
Let's do it. Starts with books. I'm a big bookie, so give me 2 recommendations, one for general life wisdom and one for real estate specific.
On the Shortness of Life by Seneca.
Oh, man, love it.
That book changed my life.
Yeah, that's a good one.
If you really sit down and really not just read it but absorb the message, it'll change. It will change your life for sure. I think that the key is really absorbing it, and that's the hard part because depending on which version you get, it could be a tough read. But there's one on YouTube. You should just Google it. You can listen to it.
Oh, nice.
Yeah, you can listen to it. It's totally free, obviously. It's on YouTube, so you can just listen to it and do that. So, that's what I would recommend. And on you said the second one's on real estate?
Yep. Or business. It could be either one.
I would say Sam Zell, am I being too subtle?
I want to pick that book up. I haven't read it, but people have recommended it.
It's very good. It's very good. I would strongly recommend that. And there's certain bits of logic that he includes in there that still makes sense even today. The old supply and demand type of scenario that I mentioned earlier. It's like I happen to do the same thing, not because of his book though, but it's also the reason why I stay in one market is because I know that there's still plenty of demand here. Anyway. Check out that one. There's a version of that also on YouTube currently, at the time of this recording. It unfortunately uses the computer voice type scenario. But you know what? If you just buy the audiobook, it's going to be way better, I think.
Nice. Yeah, those are both good recommendations. On the Shortness of Life is actually one of my favorite books. That and Meditations. Great pieces of wisdom. So I love those recommendations. All right, moving on. We are to the next question, which is for your younger self. So if you could go back to the Agostino, who let's say he just left his corporate job, got that payout, and was buying his first single family house, go to him, look him in the eye, give him one piece of advice, move him forward.
Don't be scared to get fired and go do real estate. I guess I don't know if it's 2 pieces, but when I was a corporate guy, I'm sure I'm not the only one that feels this way too. When I was working in IT, I was making very good money, and my personal value was tied to my job. Mm. And I'm sure that for many people that work in corporate, they kind of feel the same way, right? Think about it for a second. When you go to meet somebody, the first question you ask them is, what do you do?
What do you do for a living? Yep.
What do you do for a living? It's the first thing. You're defined by what you do. And that's ingrained in our society. So now if you're unemployed, we're going to say, okay, Gabe, what do you do? I'm unemployed. Guess what you are? Nobody wants to talk to you, right? And it's kind of like that's what I kept telling myself. And if I would have just taken the chance, taken a risk, and got into real estate when I was a young guy, my life would have been completely different. But at the same time, at the other side of the coin, I think a great deal of success that we built as fast as we built it today is a part of it is because of the experience in corporate America too, right? So as much as I poo-poo corporate America, I guess you can say a great deal also of the knowledge that I learned is applied in our business too.
Yep.
So the best for someone to get the best of two worlds is to simply just not do deals by themselves, partner up with somebody that knows what the hell they're doing. That's ultimately what it is, right? Because there's a lot of people out there that don't have the corporate experience and their businesses are not run very well, or vice versa. Let's say they can run a great business, but they can't find any deals. Well, they can't put a deal together. Clearly, that's a problem too. So, but that's what I would say. I would have still taken the risk back then. I should have taken the risk, and I didn't. But now it's like I wish I would have done it sooner.
That has been echoed across many different episodes.
Really?
So many.
Really?
Well, not just everybody wishes they would have gotten started earlier. So if you're out there and you're listening and you are afraid to jump, first of all, totally get it. It's scary. Making that leap is terrifying. But everybody, Agostino is here. He's making the point. You got to make the leap because we all wish we would have got started sooner. So,
but you know what though, Gabe? I'll tell you what though. Here's the thing. You don't have to quit your job tomorrow to do this either. Right?
That's actually one of my regrets is that I did quit my job and it was terrifying. But I didn't have to. I could have stayed in corporate and kept buying houses. You can still do it as a W-2. But
it depends, right? I think we talked about this in the green room too. This business requires a whole lot of mental toughness, and you have to be able to perform even when you're in corporate. And it's hard for people to do, right? Depending on where you are in your job and the responsibilities you have and how visible you are to management and things like that, you may not be able to have that luxury of looking for deals, sourcing deals, talking to brokers, whatever. But I think that the best way for someone to get into this business is to partner up with somebody else. Yeah. This is a team sport. I'm sure if anybody listens to any of the gurus, they all say the same thing, and you know what? The guru's right. This is a team sport. Nobody buys these deals, at least when they're starting out anyway. Nobody buys it by themselves.
Yep.
So, but what I would strongly recommend to somebody, when you send out that LinkedIn email to somebody, okay, don't make it about you. Nobody cares about what you have. Your responsibility is, how do you help that other person get to where they want to go? Make that the priority. Put them first. Because if you put them first and you help them get to where they want to go, they will pull you along with them. Many people don't do that. It's all about me. And, it doesn't work that way, man. It's not how it works. It's like you have to demonstrate that, listen, I can help you get to, Gabe, you know what? So I know that you need social media. I'll tell you what. I have some friends that do social media. What do you want to see happen? I'll manage it for you for the next 6 months for no charge. You'll be like, damn, I like that idea. So now you and I start talking and build a relationship. And it's 6 months of work. Right, 6 months of work. But you know what, though? Now I have a new friend. I have Gabe. Gabe's my buddy. So, hey, Gabe, listen, I'm thinking about doing this deal. Do you have a lender that can help me with this thing? Gabe will say, sure, I got a lender for you. I got this guy over here. This person over here can help with that. I can have someone that has the inspections. I have someone that can help with the fundraising. Whatever the case may be. But people want to cut to the shortcut and just find somebody that has a whole bunch of money. They have to be vested. If they're not vested, they're not going to do the deal.
Yep. Yeah, and I love that you said that because I've had people do that to me. And the easiest way, it's a really simple thing to do, is just send somebody deals. If you know they like I love self-storage. I've had people reach out and say, hey, I saw this self-storage, even if it's on market, it doesn't even have to be off market, but they send me a deal that I wouldn't have otherwise seen. And I appreciate that. I remember the person. And so even small little things that, like seeing something on market and sending it to them, it really goes a long way. So yeah. Love that you said that. I'm going to move us on, though, to the next question. And this is, lost my spot. I do this every time. Let me see if I can find it. There it is. So businesses are built on tools. Yours is no different. So give us one tool that you could not live without.
You know what? It have to be the Google Suite, believe it or not. So we build everything in house. That's how we do things. Right or wrong, it's how we do it. So because of the way that we work in terms of sharing our information across a broad spectrum of people all over the place, certainly makes it a whole lot easier for us to share out a Google Sheet. But those Google Sheets, our underwriting models, all that stuff's all custom built. Like we build all of our stuff. That's a carryover that I did from when I used to run IT groups in corporate America. We used to build our own stuff. So I'm not saying it's the right way to do it. That's just how we do it. I just find that our stuff is more complete.
Yeah.
But yeah. Anyway, but the ability
Google
to
Sheets,
share.
man.
Google Sheets. That's it. I mean, I wish there was some special.
Yeah. You are actually the first person to say Google Sheets, so that's
maybe the other guys they're afraid, or they're like
they're probably afraid. That's my guess.
Who does that?
Google Sheets is good. I'm an Excel guy, so I like Excel, but Sheets is definitely good itself.
Yeah, that's the thing. But the only issue with Excel, the only reason we don't use Excel is because it's sharing it is very, very hard to do. So we've actually built models in Excel and then export them to Google Sheets, fix them, because usually the
something goes off.
And then we use Google Sheets from there on in. So Google Sheets, for us anyway, does everything that Excel does. Although, yes, having the native app on a computer is certainly better for performance. But
I really wish Microsoft would fix their online. I mean, it works, but it's not as good as Google Sheets. That's for sure.
Correct. It's not as good as Google Sheets. It isn't. And the way that we manage all of our deals in terms of, especially within that lease business, because that team is spread out for every document, every sheet, every model has its own deal, right? So it's a 1-to-1 ratio. We just make a copy of it, put it into storage, and do it again. And so we have basically every deal that we've ever done has its own model, so we can go back and see, okay, why did we select this deal? What were the expected returns? Eventually, we're going to expand it out and have a whole database system that does all that. And it's going to be wild, right? But all that's going to also be online.
But until then, you got Sheets. Everybody loves themselves some Google Sheets.
There we go.
All right, moving us on. This is your Superman strength. We are all gifted. We all have strengths that we uniquely give to this world. So what is your Superman strength?
I would say that my Superman strength is the ability to stay focused, even and focused and really intense for a long period of time. Like I said before, this game, the real estate game, is not an easy thing. And when I started off, I started from zero, like most people out there. And as I said, now we're at about $350 million worth of stuff. And at the beginning, it's always hard. It's always hard. The first deal is always hardest. It's always the longest. And it always sucks. Always.
Yeah.
Rule. Unless you have like
unless you're doing it with someone and they know what they're doing.
Yeah, unless you're doing it with someone and knows what they're doing, they have a ton of money, and you're putting some skin in the game, and it's a function of how much cash you bring to the table. We didn't, I didn't. So it was tough, but you know what? It's in those times of toughness that you learn and you grow. And it's one thing that Stoic philosophy, getting back to the shortness of life and meditations teaches you, is that's where the obstacle is the way. As Ryan Holiday would say, right?
Yep.
That is the way. So by getting through that, it makes you a stronger person and a better developer, a better buyer, a better asset manager. So that's what I would say. My superpower is.
Extreme focus, and that is definitely helpful in real estate because being able to focus and get through those obstacles, it can be hard, but it's part of the game, and there is no voting it. And that leads us to the second to last question. I almost didn't ask this because I know what you're going to say, but I'm going to ask it anyways because it is a question that I ask everybody. So the United States, it's a big place, a lot of square miles out there. which means there's a lot of opportunities. So what is one metro, one city that you are most excited in investing in today?
Oh my God, that's a trick question, man. No,
I know.
I'm still very bullish on Cleveland, at least for the next until next year, until next December. And this tax abatement is going to shift, and really it's about opportunistic buying. So right now it makes perfect sense to do it. I don't think it's going to slow down even past next December. I really don't. But right now our team is just focused on continuing the momentum that we have here, and eventually we're going to move off, probably somewhere south, or markets comparable to this one, right, in terms of size and scale. I do typically avoid markets where everyone is running to on purpose. Yep.
Miami, Florida, Orlando.
I love Florida, and I used to live there, right? So I know that market. I know that market very well. But because everybody's running there, I stay away from it, right? Yep. It makes sense to do so. I just don't go there, right? And because that's what drives the prices up. I was investing in Cleveland when nobody was paying attention to it. And now people are paying attention to it, So, because that deal I told you about for $70,000 a door or whatever, someone will buy it for $70,000 a door. So guess what? The stuff I bought for 30
is now worth 70.
Is now worth 70. Here we go.
That's how it works.
I get to report that to the investors, and the investors are going to be happy. There's some equity built in there. We can do the refi, pull the cash out. Everybody's happy. Why not, right? I mean, it's not based just on that, but you know what I mean. It's like we're showing there's value there, right? There's value there. So, yeah.
All right. Cleveland, it's a solid market. I'm not going to throw any shade there. So that brings us to the very last question. This is for the listeners. You've given us a lot of good advice, so I'm sure people want to reach out. What is the best way for them to do that?
Sure. All social media channels, bulletproofcashflow.com, or Bulletproof Cashflow rather, at Bulletproof Cashflow, TikTok, Facebook, LinkedIn, all of them, right? We do have a Facebook group, a Facebook page. We have a Twitter account too, that is Bulletproof CF. The website, of course, bulletproofcashflow.com. We have the investor portal on there, all that fun stuff is on there too. Yeah, so
perfect.
That's what it all is. Yeah.
All right. Bulletproof Cashflow. I will put all of those links in the show notes. So if you guys want to reach out, just go ahead and click a little more in the description. It'll pull down the full description, and in there you can find Agostino's links. So that wraps it up. Agostino, thank you very much for hopping on the show.
You bet. Thanks for inviting me. Appreciate it.
Absolutely. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.